Two stocks I'm buying at the right price. Those are stocks I'm very interested in owning. I really love those companies. And many of you guys have been asking me for my opinion on them. What's my fair value? When I'm going to buy them? So I'm going to talk about that today, let you know my opinion. The first one is more of a growth company that I believe will likely be the leader of the next bull market after this pullback is over. The second one is more of a stock that I've been talking about more recently, value stock, buying back a lot of shares. And so many of you have asked me, what's your fair value on the company? So I'm going to talk about them today, and I really hope you enjoy it as always. The first one, which might surprise many of you, I'm sure a lot of you guys will be surprised, and this is Robinhood. Robinhood stock is down 30% on the month. And I never thought in my life I would ever consider owning Robinhood. The stock was a joke back in 2021 to 2022 with GME and AMC and all the hype, and the broker shut down. There was a lot of different things with regulations. I never thought I would consider owning the company, but I'm absolutely shocked by what the company has become, how profitable they are, how amazing they are, the products they're developing, the execution of the management team. I'm just seeing it. And to me, I'm absolutely shocked by the company. And now Robinhood has over 25 million people. 25 million people with funded accounts that have increased 1.8 million year over year, or 850,000 quarter on quarter. This is insane growth for the company. And imagine what they could do to monetize them. And they've been expanding their products to monetize them. This is massive, massive scale, massive, massive growth on Robinhood. Net deposits over $16 billion in the quarter alone. And I was really shocked. I never saw Robinhood would actually get to the scale. And the innovation from the management team is pretty much unheard of. They're going after everyone. They're going after sports betting. They're going after index futures and Forex kind of trading eventually. They're going after just almost everyone. They're really disrupting banking. They're eventually going to disrupt the loan market. They're expanding internationally. This is insane. They launched, for example, Robinhood Legend, which is more of a trading platform within Robinhood. Then they have index and futures on Robinhood right now, all in Q4, all in one quarter. They also expanded options trading in the UK in Q4. They also could bet on presidential elections if you believe Trump is going to win or whatever. Now you could also bet on interest rates if you believe Powell is going to raise interest rates or cut interest rates, or what will interest rate will be. And you could even do tax loss within Robinhood to minimize your taxes based on your trades, like you could do on Fidelity and interactive brokers. I never saw Robinhood would get to this scale of execution, but I'm absolutely shocked by how fast and how rapidly the company has been innovating. And they also have Robinhood Gold right now. Robinhood Gold has 2.6 million people. It's growing 10% year on year. And massive, massive growth from there. It's like $5 a month, and you get so many different benefits, including the Gold Card, which gives you an unlimited 3% cash back on everything. No one competes with them. I believe the highest one is Citigroup with Citi Double Cash, where they have 2% cash back. This one has 3% unlimited cash back. And it's a very cool looking card, and they send it to you in like a little box. It's like I'm looking into American Express. I mean, this is what kind of scale and the kind of advertising that Robinhood is associating themselves with, and people are showing it off on YouTube and on X, and people want the same card and they're ordering it from Robinhood. This is insane. I mean, I'm seeing the potential for the monetization. I'm seeing the potential from the debit cards, from all the Robinhood Gold members, from sports betting, which now you could bet on baseball, I believe, and other kind of games, to betting on elections, to betting on everything else. And this is getting more and more popular. People believe it's more and more fun. And more people are downloading Robinhood, and they're sharing their results on X, YouTube, Instagram, and it's encouraging more people to download Robinhood and do the same thing. This is insane. I mean, I never thought, Robinhood would really get to the scale. Now, the main problem with Robinhood is a mixture of their revenues. Like most of their revenues come from transaction-based revenue, which is mainly payment for order flow. The more you trade, the more money Robinhood is going to make. And this is something good for the company because the average holding period has decreased, and everyone right now is mostly a short-term thinker. You don't have a lot of long-term investors left. So people act more than they should, especially with 24 hours trading and all that stuff. So you always have the tendency to act. And the more you act, the more money Robinhood's going to make. So I encourage you not to give your money to Robinhood. but that's how the company makes money. But then they have net interest revenue around 300 million, and that's mainly from, you could say, when you lend your shares, Robinhood gets a fee on lending the shares, on margin interest, the interest spread on your cash. They give you 4.5%. Maybe they collect like 1% difference or whatever they do, and this is how they make their money. Now the main problem is, if you look at the transaction-based revenue, it is up 200% year on year, but it's mainly due to a few things. The first one is, you could say, just look at equities. Equities is only 61 million. 61 million is really nothing. Now, if you look at options was 222 million, and cryptocurrencies record 358 million after only being 61 million the quarter prior to that. So this is really unsustainable for Robinhood. I would prefer to see more equity kind of volumes and equity kind of transactional revenues, because this is more sustainable for the long term. And people buy stocks, they tend to hold them for the long term. But options are a short-term phenomena, and it's the same thing with crypto. And you really need a very strong bull market to people for people to bet on that stuff and trade all those things. But if we have a bear market for a while, Robinhood is gonna suffer in terms of their volumes on cryptocurrencies and other kind of, you could say, speculative assets in general. So this is a drawback of Robinhood, and they need more stable, more equity, more recurring revenue kind of models. And this is why they're expanding Robinhood Gold. And this is why they're expanding into retirement accounts by having like a 3% match, which a lot of people I'm seeing on X, they're transferring their IRAs and retirement account all to Robinhood. And that has grown over 7x from Q4 of 2023, over $13 billion. And this is more recurring revenue stuff, more stable revenues, because in retirement accounts, most people don't trade them. They kind of put in money every month within a managed account, and they hold it for the long term. So this is more stable, recurring revenue business model, which is going to help Robinhood be a little bit more predictable over the very long term as they transition into such more stable products. And the last thing that has impressed me by the company is mainly how they track stock-based compensation and share dilution. Like most companies, they don't really do that. And they're really being transparent, and they're showing you their diluted shares outstanding being pretty much flat or only up like 1% year on year. And they're also showing you stock-based compensation, which is very important, as a percentage of revenues. So they're actually showing off, they're actually satisfied, and they're showing their investors that stock-based compensation as a percentage of revenues went from 17% to only 8%. So they actually understand how shareholder value is created, and they're being transparent by it for a lot of retail investors, which I found very, very interesting. The company is profitable on a GAAP basis. It was unprofitable in 2021, losing $7.49. Now they're profitable for the first time on a GAAP basis in 2024, and stock-based compensation is going down, which I care about very much as an investor. Now, if you look at the PE ratio, the forward PE ratio is around 22.5 times earnings. And the PE ratio is mainly pricing in a decline of 17% in earnings per share for 2025, which is highly likely because of the market being lower, people not trading as much crypto as they did in 2024, and options and many different things. So I believe 17% is likely, as a lot of the growth within Robinhood on the gold card and all that will likely offset the decline from crypto volumes and other kind of things. So I think pricing in a 17% earnings contraction is fair. But after the earnings contraction, Robinhood is still trading at 22 times forward earnings. Now, 22 times forward earnings for a company that will likely, in my opinion, continue to grow earnings per share 20% a year for many years to come, you're pretty much paying around 1 times growth, 1 times price to earnings growth, which is dirt cheap for a company like Robinhood that I personally believe is likely going to be the leader of the next bull market. Is taking market share from traditional banks. They're expanding in a lot of different countries, a lot of things within sport betting. I mean, the TAM is huge, and they have the platforms, they have the UI. It's very easy to use, very simple. I see it, how they're disrupting the market and how they're expanding. So I believe Robinhood, maybe it sounds funny right now, and we'll come back to this video in a year from now, but I believe it's going to be the leader of the next bull market, one of the leaders, a Palantir-like move in terms of the stock, explosive kind of earnings growth and explosive kind of multiple. I mean, the stock should really be trading more than 21 PE, maybe 30 to 40 PE. So for me, the way I look at Robinhood, I think the stock is even attractive right now, to be honest. I prefer close to $30 or below. It's my fair value on Robinhood. But even right now, in my opinion, the stock looks really, really good as a long-term investment. And I always tell people, when you're buying such stocks, you start small and then you dollar cost average down. You don't go all in, because then if you're right on Robinhood, Robinhood goes up 10 times. You don't need to put in a lot of money to make money. But if you're wrong on Robinhood and it goes to zero or whatever, then you don't lose too much. So this is how I structure position sizing within my portfolio. Now, the second one, which is by popular demand, I got at least 20 comments asking me, please give us your fair value on the stock because you talk about it all the time. And this stock is Toll Brothers. Toll Brothers is down 40% from all-time high. And I did tell you guys that I have a thesis around housing, and I think housing will likely be also the leader of the next bull market, as the Secretary of Treasury Scott Bessent and even Trump, they keep talking about lowering the 10-year, lowering interest rates, lowering mortgage rates. And this is exactly what's happening. The 10-year is going down. Mortgage rates are still elevated, but they're starting to pull down. And when the Fed eventually turning from QT to QE, this is very bullish for housing. And I believe it's very bullish for Toll Brothers. And I believe the market is starting to wake up to the trend. Because as you could see on Friday, a lot of those stocks were extremely red. It was a massive, massive bloodbath on the market. But you look at the home improvement stocks, a lot of them were flat to positive. If you look at a lot of the construction stocks, like D.R. Horton, Lennar, and others, they were up 2, 3, 4% on the day, despite the entire market going down. So this is massive relative strength, and maybe the market is telling us that this is what's going to be next. And this is sometimes how you identify such trends. Although I hope I'm wrong, and I hope they continue going lower, because I really want to own them, but I also want to make sure I'm not overpaying. Now with Toll Brothers, this is more of a premium, you could say, housing construction kind of stock. Their average selling price is $955,000. So they're not more focused on the lower end, they're focused on the mid-range to higher end kind of homes, which those people are more immune to interest rate fluctuations and other kind of things than the lower income people, you could say, or lower home prices in general. Now, if you look at the new home premium before like 2020, back in 2016, 2017, if you wanted to buy a new house, it was trading at a massive premium to old homes. But as the supply of old homes has increased, the premium between a new house and an old house has narrowed to pretty much zero, like 3 to 5%. So for the same price that you're paying for an old home, you could buy a new house, and you don't have to worry about maintenance for the next maybe 10 years, because a lot of them have builder warranties. There's pretty much no premium to buying a new house versus an old one. So why would you buy an old house if you can buy a new one for the same exact price? And this is why a lot of people are buying a new house instead of an old one. And something like Toll Brothers, they're in over 24 states, in a lot of high growth states like Texas, Florida, and in Nevada, and many different kind of states. Now, what Toll Brothers is doing is the same thing that NVR did. And if you're not familiar with NVR, NVR is one of the best, you could say, construction or housing stocks of all time. It's up thousands and thousands of percent. And they had something special. And what NVR did, instead of them buying the land, building the homes, and then waiting to sell the homes, they use something called a land option. So they have an option to buy the land if they get enough deposits, if they get enough commitments from potential buyers on this specific land. Once they get enough buyers, enough people that are interested in buying, they get deposits, they get commitments, then they buy the land and they build the homes. They don't just build homes and sit and wait for them to sell them. They have an option to buy the land. They pay like a fee for an option to buy it. If they get enough people interested, they buy the land. If not, then they lose a tiny percentage on fees, which is much more efficient than them buying a land and then sitting on empty land and empty homes. And for Toll Brothers, it's kind of the same thing. Only 44% of their land is owned and 56% is optioned. So they have the option to buy it and they can walk away from this land pretty much any time. And the company is very focused on creating per share value. They track book value per share. up 13% CAGR at $76.87. We look at earnings per share, it's up at a 28% CAGR to $15.01 in earnings per share. And the company is well known for cannibalizing the stock. They keep buying back stock like crazy from 185 million to 104 million. And they just keep on buying the stock. And this is amazing. And the best part about it is the company has no debt that's due in 2025 and no major debt maturities before 2030, which means if the stock continues going down, the company can get very aggressive and potentially leverage up the balance sheet to buy Toll Brothers stock at dirt cheap prices and create shareholder value for the very long term. Now, if you look at the last earnings report, it wasn't good at all. Net income has started to decline, not a lot, but a little bit. If you look at the quarter end backlog, it went from 7.8 billion to 6.94. So it has declined a little bit, like 4%, not a lot, but it's starting to decline. Which is very important to look at within the overall sector, because this is a cyclical sector. And anytime you see the backlog going down, this is normally a sign of an industry that's not doing too good. But the market knows that, and that's why Toll Brothers is down almost 40% from all-time high, as a lot of their inventories right now are increasing, and the housing market is pretty much froze up for the moment. Now, if you look at the free cash flow yield, the stock looks very cheap. It's sitting at a 15% free cash flow yield. But the problem is, because it's a cyclical industry, if they have disappointing quarters over the next 2 or 3 quarters, and the estimates get revised lower, then the free cash flow yield would have been a trap, and it would have ended up being much lower than expected, which is going to drive the stock price much, much lower. And that's why, for example, if you look back at Toll Brothers, around $140, the stock was cheap. People said it was cheap. At $150, it also looked cheap. Even at $170, $175, you could have said the stock is cheap because the free cash flow yield is over 10%. But they continued to disappoint on the quarters, and then the free cash flow yield ended up being a trap, causing the stock in general to be a value trap. So valuing Toll Brothers isn't really easy to do. It's very hard to do. But the way I'm doing it is I'm looking at book value per share, trailing book value per share. Now it's sitting at 1.29 times book value per share. The mean is 1.3 times book value per share. But the stock has historically bottomed, even in 2022, at or below 1 time price to book value per share. Even here, 1 time. As you see on this line, this has been a good time to be buying Toll Brothers. Now, the book value per share is $76.87. And they will likely grow book value per share this year, in my opinion, around 6%. If they buy back 6% of the market cap, they will likely grow book value per share around 6%, which is around, I believe, $80 or $81. So $80 or $81, this is like 23% from here, or this is 76. $80 to $81, this is like 18% from here. It's not impossible, but I kind of believe it's highly unlikely it's going to get there because of how much it's been going down and how oversold the stock is. I hope it does, but I doubt it's going to get there. So for me personally, I'm likely going to buy the stock like at $90 or below. So below $90, I think is a sweet spot to start potentially buying Toll Brothers and dollar cost averaging down. And I hope it does get there. And I share everything I do in my own Discord, all my buys, everything in real time. This is the link if you're interested. But thank you very much for watching. I hope you enjoyed it. Not financial advice. If you did enjoy it, let me know in the comments. Thank you again. And I'll talk to you in another update.